Isn't it fascinating when the expected playbook just gets tossed out the window?
Yeah.
We're seeing a really head-scratching situation unfold in global finance right now.
Mm-hmm.
That traditional reaction to market wobbles, that classic flight to safety. It just isn't behaving as we've come to expect.
Absolutely. For years, any hint of global economic uncertainty, it would reliably send investors running towards the perceived security of U.S. Treasury bonds. It was almost like a knee-jerk reaction.
Yeah,
But the data we've been looking at suggests a pretty significant departure from that norm.
exactly. And that's precisely what we're diving deep into today. We've immersed in some really, really thought-provoking analysis from the Capital Mind blog.
The piece Flight to Safety, but on another airline.
Yes. That's the one.
Yeah.
It really gets under the skin of how these recent tariffs, particularly the ones issued by the U.S., are creating these, unexpected shifts in global trade and investment.
Yeah, our aim here, I think, is to look beyond just the immediate headlines about the tariffs, right? And really try to grasp the fundamental changes that are in motion. We want to highlight some of the more maybe surprising aspects.
Yeah, challenge some conventional wisdom.
Exactly. Challenge some of those long-held assumptions about how global markets typically respond to this sort of thing.
Okay, so the Capital Mind piece, it kicks things off by looking at what they called Trump's Liberation Day. That was back on April 2nd, 2025.
Right, the unveiling day.
Yeah, that was the day these broad tariffs were introduced. Initially, a pretty substantial 20% levy on goods from most countries.
And that initial announcement, it really set the stage. The very next day, boom, 25% tariff on auto imports.
Wow.
And then following that, more targeted increases. China got hit with a huge jump, up to 125%.
125.
Yeah, and Vietnam, 46%, Sri Lanka, 44%. It was a rapid escalation.
You can imagine it sent some serious tremors through the markets.
Oh, for sure.
The blog notes there was a subsequent partial pause, like a 90-day window for most nations, though not China.
Right, China was excluded.
And they lowered the baseline to 10%. But as they emphasize, the initial jolt to market sentiment, that had already happened.
And that initial market reaction is, well, it's crucial because it's forcing us to reconsider some very basic assumptions about the U.S. and its place in the world economy.
Right. For a long time, you hear this narrative, don't you, about a decline in U.S. global trade influence.
Yeah. That's the standard story.
But the Capital Mind analysis throws a really interesting twist in there. They point out the U.S. has actually managed to slightly increase its proportion of total global merchandise exports. How does that fit?
It's a key piece of the puzzle, isn't it? I mean, while nobody denies China's growing export power, the U.S. has shown the surprising resilience, maintaining, even modestly expanding its share.
So the picture's more complex than just America's losing out.
Exactly. It's not a simple decline story.
And it's not just exports, right? They also highlight the remarkable stability of the U.S. global import share. It's held steady around 13.1%.
Pretty consistent, yeah. We haven't seen some huge surge in imports driving this, despite all the rhetoric.
Okay. So this leads to the fundamental question then. If the U.S. isn't collapsing in exports or exploding in imports, what's the real driver behind these tariffs? What's the bigger picture?
Well, the Capital Mind team argues, and I think compellingly, that the underlying story is really about debt. And that massive, persistent U.S. goods trade deficit, what is it now? Around $1.2 trillion a year.
That's a huge number. Massive outflow of dollars.
And this is where their analogy of printing IOUs becomes quite insightful. For a long time, there was this sort of unspoken arrangement, right? Countries running trade surpluses with the U.S., think China, Japan, they basically recycle those excess dollars back into U.S. Treasury bonds.
Lending us back the money we spent on their
Pretty much. And that provided the U.S. with relatively cheap financing for its deficits. It was a kind of, self-sustaining loop.
A neat system while it lasted.
But what's truly remarkable, and this is a key point in the analysis, is the change we've seen in who holds U.S. debt over the past decade or so.
Oh.
Major trading partners, the very countries with these big surpluses, have actually been reducing their holdings of U.S. government debt. That's a fundamental shift.
Wow. Okay. That really changes the equation, doesn't it?
It does.
And the blog even quotes a Fed official making a really thought-provoking statement. Let me see here. We're not just taxing imports. We're taxing the global financial system's exit from dollar dominance.
That's a powerful quote. It makes you think much bigger, beyond just trade figures.
Yeah, it suggests these tariffs might be less about fixing, say, a specific trade imbalance and maybe more strategically aimed at managing this slow, gradual shift away from a world where the U.S. dollar is the undisputed king.
It certainly puts a different spin on it. Less about goods, maybe more about finance and global power dynamics.
Okay, let's shift gears. China. You'd think these huge tariffs, 125%, would cause absolute panic there, right?
You might expect that, yeah. But the data presented in the Capital Mine piece paints a somewhat different picture.
How so?
What's really noteworthy is the trend in the U.S. share of China's total exports. It used to be over 17%,
Okay.
but by 2024, it had dropped to just 14.7%. That's the lowest it's been in a decade.
So China's been deliberately diversifying,
Yeah.
finding other customers.
It certainly looks that way. They've been actively cultivating other markets, which of course lessens their vulnerability to specifically U.S. tariffs.
Right, if the U.S. isn't your overwhelmingly number one buyer anymore, the tariffs still hurt, obviously, but there may be less of an existential threat.
Exactly. Less of a potentially crippling blow.
Yeah.
Now, this leads us to what I found personally one of the most surprising developments in all this.
Okay.
The reaction in the bond markets. As we said earlier, conventional wisdom, right? Global uncertainty goes up.
Investors flock to safe U.S. treasuries, yields go down.
Precisely, the classic flight to safety. But what actually happened after these tariff announcements in early April 2025 was, well, the exact opposite.
Don't tell me yields went up.
Significantly, U.S. Treasury yields spiked upwards. The 10-year yield jumped from around 3.87% to nearly 4.5%.
Wow.
And the 30-year yield climbed even higher, crossing 4.9%. That's a notable increase in the U.S. government's borrowing costs.
That is completely counterintuitive. Fear about tariffs and trade wars should have made treasuries more attractive, pushing yields down.
That's what traditional theory would predict, yes. But instead, the market demanded a higher interest rate from the U.S. government.
And how did this compare to other major economies? Was everyone's borrowing costs going up?
No,
Yeah.
and that's the crucial contrast. The Capital Mine piece highlights how German 10-year bond yields actually decreased, went down 12 basis points to 2.18%.
Okay, so money flowed into German bonds.
And Japanese 10-year yields also compressed, down 8 basis points to 1.5%. Even Indian 10-year yields were pretty stable, maybe even slightly down to 6.34%.
So U.S. yields up, German and Japanese yields down, India stable. That's a stark divergence.
Yeah. It's incredibly telling. While U.S. borrowing costs were rising, bonds from places like Germany and Japan, other traditional safe havens, were getting more expensive as investors bought them, pushing their yields down.
It strongly suggests that old market reflex isn't automatic anymore.
Not at all. And this brings us right back to the title of that Capital Mine piece, Flight to Safety, but on another airline.
Right. Investors are clearly looking for safety, for a safe place to park capital in uncertain times.
But they're choosing destinations other than the traditional U.S. Treasury market, maybe Frankfurt, Tokyo,
Yeah.
even Mumbai, looking at those stable Indian yields.
So why? Why this shift away from treasuries? The blog suggests a few key reasons.
Yes, they break it down into roughly three main drivers. First, there's this idea of a growing currency risk premium.
Meaning?
Well, given the huge U.S. deficits and the sheer amount of Treasury bonds being issued to fund them, there's a rising concern about the dollar potentially weakening down the line.
Ah, okay. So international investors are thinking, if I buy these dollar bonds, will the dollar be worth less when I get my money back in my own currency?
Exactly. So they demand a higher yield, maybe 70, 80 basis points higher, according to some estimates, just to compensate for that potential dollar weakness risk.
Makes sense. What's the second factor?
Second, a kind of supply-demand imbalance. These tariffs hit just as the U.S. Treasury was already ramping up its bond auctions to fund the deficit.
Right.
And there were signs, like a not-so-great 3-year Treasury auction mentioned in the piece, that demand just wasn't keeping pace with that increased supply.
Basic economics. More supply than demand at the current price. Price falls, yield goes up.
Precisely. And the third big factor is this ongoing geopolitical rebalancing we touched on earlier.
The foreign holders selling off.
Well, not necessarily a sudden sell-off, because that would hurt the value of their remaining holdings. It's more subtle. Major holders, like China, seem to be gradually, quietly diversifying their reserves.
So not actively dumping, but maybe not buying new treasuries when their old ones mature.
That seems to be the strategy, a reluctance to reinvest or buy new issues. And that subtle but significant reduction in demand adds further upward pressure on U.S. yields.
So you've got this potent mix. Worries about the dollar's future value, potentially too much new treasury supply hitting the market, and key foreign buyers slowly backing away.
It all comes together to create this unusual situation. Rising U.S. borrowing costs precisely when you expect them to fall due to global uncertainty.
And the implications are
Yeah.
Well, they seem pretty profound. It suggests the world no longer just automatically reaches for treasuries as the ultimate safe asset.
It really shakes things up. It impacts the U.S. government's ability to finance itself affordably and has knock-on effects for the entire global financial system.
The blog also talks about the tricky spot this puts the Federal Reserve in. A real dilemma, isn't it?
Absolutely, a very tough balancing act. If they cut interest rates to try and help the Treasury market, make borrowing cheaper for the government.
They risk weakening the dollar even more and maybe stoking inflation.
Exactly. But if they hold firm, keep rates where they are, or even raise them to fight inflation or support the dollar.
Then the cost of servicing that massive U.S. debt could just explode,
hmm
especially with, what was the figure, $9.2 trillion needing refinancing this year alone.
A staggering amount. It's a real tightrope walk for the Fed.
And it's important to remember, isn't it, that the Fed controls the short end of the interest rate curve, but the long end, those 10-year, 30-year yields we're talking about.
That's ultimately set by the market, by investor perceptions of risk, inflation, growth, and importantly, the long-term creditworthiness of the issuer.
So that 30-year Treasury yield crossing 4.9%, that's the market sending a pretty clear message, isn't it?
It is. It's expressing concern about the U.S. government's ability to manage its debt burden in the long run without resorting to, well, inflating away the value of the currency.
Which brings up the nasty prospect of stagflation.
Yeah.
Higher inflation, maybe from the tariffs making imports costlier.
That combined with slower economic growth, perhaps due to disrupted trade and higher borrowing costs. It's a scenario policymakers desperately want to avoid.
Yeah. And underlying all this is the bigger long-term question mark, isn't it? About the future of the U.S. dollar as the world's main reserve currency.
hmm If these kinds of policies, intended or not, accelerate a move away from dollar dominance, the global financial landscape could look very different in the coming years.
Just to put the current cost into perspective, the blog mentions the U.S. government now spends about 16% of its entire budget just on interest payments for the debt.
16%. That's now more than the entire defense budget.
Wow. And as yields rise, that percentage only goes up, potentially squeezing out spending on other things.
It becomes a heavier and heavier burden. And for you, the listener, thinking as an investor, this really forces a rethink.
Yeah.
What do we even mean by a risk-free asset anymore? The volatility we've recently seen in U.S. Treasuries, the bedrock of the system, has actually been higher than in many stock market indices.
That completely flips conventional portfolio wisdom on its head. Treasury is more volatile than stocks.
At times, recently, yes, it challenges those core assumptions about diversification and risk management.
Okay, shifting focus slightly again, let's talk about India's position in all this. The Capital Mine piece had an interesting little detail about India's exports to the U.S.
Ah, yes, debunking a common myth.
Right. Everyone assumes it's mostly pharma and jewelry, but apparently the top category is actually electronics now.
It is. Shows how trade patterns evolve, doesn't it? An interesting detail often missed.
And what about India's likely reaction to the U.S. tariffs? Does the analysis expect big retaliation?
Not necessarily. The thinking seems to be that India, while growing fast, is still a relatively smaller player in the overall U.S. trade picture compared to, say, China or Europe.
Okay.
So the argument goes, maybe India doesn't need to retaliate strongly. Perhaps the negative impact of the tariffs on American consumers' higher prices in stores might eventually be enough pressure for the U.S. to reconsider its stance anyway.
So it's sort of strategic patience. Let the domestic consequences in the U.S. play out.
That seems to be the implication, a kind of waiting game.
So pulling it all together,
Yeah.
what does the capital mind analysis suggest is the likely end game here? Where is this all heading?
Well, they argue the global economic order was already changing, already shifting. These tariffs are basically just accelerating that process.
So no going back to a completely free trade, zero tariff world.
That seems unlikely, and maybe not even the U.S. goal, frankly. The focus will probably shift towards negotiating specific deals, bilateral or regional, that are seen as more favorable.
And we should expect countries to look elsewhere for growth,
Right.
not just rely on selling to the U.S.
Definitely. A continued move towards diversifying export markets, looking more towards Europe, other parts of Asia, maybe India itself as a major consumption center grows.
A rebalancing of global demand.
Yes, and alongside that, we should probably expect continued protectionism elsewhere too, including potentially in India. As global trade gets disrupted, countries will want to shield their own industries from sudden import surges caused by goods being diverted from, say, the U.S. market.
Ah, okay. Protecting the home front.
And likely a bigger global push towards boosting domestic manufacturing, especially in critical sectors. Think defense, Pharmaceuticals, semiconductors, national security playing a bigger role in trade policy.
So the big takeaway seems to be that resilience, flexibility, adaptability, those are the key things now.
Absolutely. And the piece concludes on an interesting note for India, suggesting that through these market shifts, India is kind of emerging as a strategic hedge, a place of relative stability and opportunity in this more complex global order.
Okay, so let's quickly recap the really surprising things from this deep dive.
For me, number one is that bond market reaction. U.S. yields going up during uncertainty. That's huge.
Yeah, the traditional safe haven not acting so safe, which leads to the second point.
The whole perception of what is a safe asset is shifting. Investors are looking at German bonds, Japanese government bonds, maybe even Indian bonds differently now.
And third, the big underlying implication, what this all means for the future role of the U.S. dollar globally. Are we seeing an acceleration away from dollar dominance?
It certainly raises that question very forcefully. These aren't just tariff headlines, they're potentially signals of much deeper structural changes in global finance.
Definitely shows there are significant forces at work way below the surface. It's not just about trade negotiations. It's about how money flows around the world, how investors behave.
Which brings us to a final thought for you, our listener, to chew on.
Go ahead.
Given this pretty dramatic shift we're seeing in global finance, this challenge to the old rules, what long-held assumptions about your own investment strategy, about economic stability, might you need to re-examine?
Hmm. That's a good question. It really feels like a crucial time to dig deeper into these global trade dynamics and think hard about the future of money itself, doesn't it?
Absolutely. Lots to think about.